Okay, let's unpack this. We are diving into a European Union court case, C79423. Now, it sounds intensely technical. It's all about VAT corrections. But it actually starts with a really simple mistake.
Yeah, a mistake at a small business, believe it or not. An indoor playground in Austria, of all places.
Right. And it's kind of the perfect example, isn't it? Shows how these very specific local mess-ups can end up forcing the top courts in Europe to make these big rulings.
Absolutely. Rulings that, potentially redefine tax compliance for basically any business that uses a cash register and gives out those little low-value receipts, think coffee shops, corner stores.
Yeah, exactly. Okay, so let's set the scene for you. We've got this company, PGMBH. They run an indoor playground.
Standard stuff. Kids running around, parents watching.
And back in 2019, they were just using their normal till system, but they made a classic admin error.
Happens all the time. What was it?
They charged the standard 20% VAT rate on all their admission tickets.
Yeah.
But they should have been charging the reduced rate, which was 13%.
Ouch. So a 7% overcharge on every single ticket.
Every single one. And these were, the basic till receipts, low value, lots of them, the kind that fall under the EU's simplified invoicing rules, usually under 400 euros.
Right. So thousands of these little receipts. And for the whole year, they collected that extra 7% and dutifully paid it over to the Austrian government.
Until, of course, they realized their mistake. So PGMBH goes to the Austrian tax authority and says, hey, look, we messed up. We overpaid you. We'd like that difference back, please, so we can fix our accounts.
And the tax authority's response?
Immediate refusal. Just nope.
Okay, why? What was their reasoning?
Well, their argument hinged on this idea of unjust enrichment. There's apparently a bit in the Austrian tax code, paragraph 239A, that lets the authority reject an adjustment if the company would somehow unfairly profit from it.
Ah, okay, let's break that down. Unjust enrichment. Because the playground got the 20% VAT from the customers, the parents buying tickets.
Exactly. So if the government now refunds that extra 7% back to PGMBH, the playground company, well, they can't exactly track down thousands of individual parents from 2019 to give them back their few cents or euros, can they?
Not realistically, no. So the government's saying, hold on, you'd just pocket that difference. You'd be profiting from your own mistake.
That's the argument. So the core issue became, when can a business actually fix an overcharge like this on simplified receipts without hitting this unjust enrichment problem, especially if there's actually no risk of the government losing tax money?
And that question goes right to the heart of a fundamental EU VAT principle, doesn't it? The anti-fraud rule.
Yeah, tell us about that. The basic rule is if I put VAT on an invoice, even the wrong amount, I owe it to the government. Why is that?
Well, it's purely a safety mechanism. It's there to stop the tax authorities losing out. The logic is if you issue an invoice with incorrect VAT, the risk is that the person who received that invoice, your customer, might try to claim that incorrect amount back as input tax deduction.
Ah, I see. So if they deduct it and I haven't paid it over.
The state loses twice. One's from the deduction, one's from you not paying. So the rule is pretty absolute. You invoiced it, you owe it. Unless, and this is the key part, unless you can prove definitively that there is zero risk of that deduction happening.
Okay, and that brings us to the history of this specific case, because this wasn't the first time this playground went to the ECJ, right?
No, exactly. Back in 2022, there was an earlier ruling, C37821, involving the same company, and that ruling laid the groundwork.
What did it say?
It established the basic principle. A business is not liable for the overcharged VAT if, and this is crucial, if the recipients of their service are exclusively final consumers who have no right to deduct VAT.
Makes sense. If the customers are just ordinary people, like parents buying tickets for their kids, they can't claim VAT back anyway, so the state isn't losing anything if the playground overcharged.
Precisely. No risk, no liability under that specific anti-fraud rule. The principle seems clear.
But, and there's always a but, the reality of the indoor playground business created a problem.
The real-world mess, yeah. PGMBH argued they served almost exclusively private individuals, but they couldn't guarantee 100% exclusivity.
Right. Like, what if a self-employed photographer bought a ticket because they were hired to cover a kid's birthday party there?
Or maybe a small local business holds a, very short team event there. It's unlikely, maybe, but not impossible that theoretical risk wasn't zero.
And this is where it got slightly absurd, wasn't it? The Austrian courts tried to deal with this tiny risk by guessing.
Yeah, the Federal Finance Court actually tried to estimate it. They basically plucked a figure out of the air and said, okay, let's estimate that maybe 0.5% of the total turnover went to taxable persons.
0.5%. They even calculated it as about 112 receipts out of over 22,000.
Incredible level of detail for a guess, but unsurprisingly, the tax authority didn't like that. They appealed.
On what grounds?
They argued that the ECJ's 2022 ruling didn't say anything about splitting turnover based on an estimate. It was supposed to be about exclusivity. You couldn't just carve out a tiny percentage.
So that forced the Austrian Supreme Administrative Court to go back to the European Court of Justice.
Yep. With 3 new, very specific questions basically asking, okay, how do we handle this messy reality?
Right, let's dig into those. Questions 1 and 2 were really about defining the customer, weren't they?
They were. Question 1 was about the focus. Do we look at the supplier's general customer base, or does liability depend only on the specific person who got the incorrect invoice?
And the ECJ said.
Very clearly, it's invoice by invoice. The potential risk of tax loss has to be assessed for each specific transaction. Your overall business mix, maybe you sell to businesses 50% of the time. Normally, that doesn't matter for this specific incorrect invoice.
Okay, so if PGMBH could somehow prove that receipt number 1234 went to Mrs. Smith, a private individual,
Then for that transaction, they are not liable for the overcharged VAT. It isolates the risk assessment.
that seems fair.
Hmm.
But then comes question 2, the definition problem. This is the tricky one.
Uh-huh. Who exactly counts as a final consumer who does not have a right to deduct input VAT?
Does that definition include, say, a business owner, someone who's a taxable person, but they're buying the playground ticket for purely private reasons, like for their own kid's birthday party, nothing to do with their business?
And this is where the court's answer has huge practical implications. They were incredibly strict.
How strict?
They ruled that the term final consumer in this context means only non-taxable persons. Full stop.
Wait, so taxable persons are completely excluded from that definition,
Yeah.
even if they buy something for purely private use where they absolutely cannot legally deduct the VAT?
Correct. Even then, they are excluded.
Hold on, I need to understand the logic there. If I'm a CEO and I buy a ticket for my kid's party at the playground, I know I can't claim that VAT back. The law forbids it. So where's the risk to the tax authority?
The ECJ's rationale seems to be rooted in, let's call it administrative simplicity and a zero-tolerance approach to potential fraud. They're essentially saying that tax authorities can't realistically be expected to verify the purpose behind every single low-value transaction.
Too complicated to check if it was private or business.
Exactly. Was it genuinely private? Was it maybe mixed use? Could there be some complex business structure or circumstance that might somehow allow a deduction attempt later? The court seems to think that policing this intention is too hard.
So to eliminate any possibility of revenue loss, however remote.
They draw a hard line. If the recipient is registered for VAT, a taxable entity, they are considered a potential risk, regardless of the reason for that specific purchase.
Wow. Okay. And the consequence is that the vendor, the playground in this case, remains liable for the overcharged VAT for any receipt issued to such a person.
That's the sting. It effectively means that for any business issuing lots of these simplified anonymous receipts,
Like cafes, shops, cinemas.
you basically have to assume that any customer could be a taxable entity unless you have concrete proof otherwise. The burden of proof just massively shifted onto the business trying to correct the error.
Which leads perfectly into the third question, the practical one.
The how on earth do we prove this question?
Right? PGMBH issues thousands of till receipts. They don't ask for names. They don't know who those customers are. How can they possibly meet this strict burden of proof? Can they use that 0.5% estimate the lower court tried?
This was the plea for procedural help, really. How do we assess this when the documents just don't identify the customer type?
So what was the ECJ's guidance on using estimates in this simplified invoicing world?
Well, first they reiterated the principle of procedural autonomy. EU law doesn't dictate the exact methods for identification or proof. That's generally up to each member state's national law.
Okay, so Austria gets to decide how PGMBH proves its case.
To an extent. But, and this is the crucial EU overlay, national rules must respect the principle of effectiveness. The national procedure can't make it practically impossible or excessively difficult for PGMBH to exercise its EU right to adjust or get a refund if there genuinely was no risk of tax loss.
Okay, so if Austria just said, nope, no names on receipts, no refund, that would likely violate effectiveness.
Exactly. Because it would deny the possibility of correction based purely on the nature of simplified invoicing. Therefore, the ECJ concluded,
Estimates must be allowed.
yes, using an estimate to figure out the likely proportion of receipts that went to taxable persons versus non-taxable persons is not precluded by EU law. It's permissible.
Okay, that's a lifeline. But presumably you can't just make up any old number, like that 0.5% guess.
Right. The estimate has to be grounded in something solid. The court stressed the principles of fiscal neutrality and proportionality.
Meaning?
The estimate needs to be based on correct, reliable, and up-to-date data. The court does examples like looking at the nature of the service. An indoor playground inherently leans towards private consumers, or using relevant statistical information about consumer behavior in that area.
So it has to be a reasonable data-supported estimate proportionate to the situation.
Precisely. And crucially, the estimate isn't the final word. It creates what the court termed a rebuttable presumption.
Rebuttable meaning PGMBH can fight it.
Yes. The company must have the right to challenge the tax authority's estimate. They must be allowed to present their own counter-evidence, maybe customer surveys, market analysis, whatever they have, and argue their case without facing an excessively high standard of proof.
So the process has to be fair. It can't just lock the company into paying tax that was genuinely overcharged and never claimed by anyone.
That's the principle of fiscal neutrality kicking in. The system has to allow for correction when no harm was done to the public purse.
So this ruling, C79423, it really provides a kind of roadmap, doesn't it?
Yep.
For how businesses dealing with these high-volume, low-value, anonymous transactions can actually navigate correcting a VAT mistake.
It does. It acknowledges the practical problem of simplified invoicing, allows estimation as a tool, but sets quite high bars and procedural safeguards to protect that core EU principle, preventing tax revenue loss.
Okay, let's summarize the key takeaways for everyone listening.
Yeah.
What are the big 3 points from this deep dive?
All right, first, when you're trying to correct overcharged VAT, the assessment of risk, the risk of someone deducting it is done per invoice, not based on your general customer profile.
Got it. Specific transaction matters most. Second.
Second, that crucial definition of a final consumer, the type of customer that eliminates the risk, is interpreted very strictly. It means only non-taxable persons. If your customer is a registered business or self-employed, even buying for private use, they don't count under this rule. The vendor stays liable.
That's the really tough one operationally. And the third point.
Third, in situations like the playground with tons of simplified, anonymous receipts, using estimates to determine the split between taxable and non-taxable customers is allowed. But those estimates have to be based on reliable data, be proportionate, and importantly, the business must have a fair chance to challenge and rebut the estimate presented by the tax authorities.
Right. Procedural fairness is key.
Absolutely. The case really throws a spotlight on this constant tension in tax law, doesn't it? Balancing the need to prevent potential fraud and revenue loss against the need for fairness, preventing the government from basically getting a windfall from an honest mistake.
It really does. And that brings me to a final thought for you to consider. Given how strict that definition of final consumer is now, it forces businesses issuing simplified receipts to essentially treat almost every anonymous customer as a potential tax risk. Think about the operational headache. If a small business like this playground has to potentially gather national statistics, commission market research, and prepare legal arguments just to potentially get back a 7% VAT overpayment on low-value tickets, how much complexity and cost does this ruling add to everyday tax compliance for potentially millions of small businesses across Europe? Is the cure worse than the disease?